Hey guys, welcome to the Wealth for Real YouTube channel. I'm your host, Christopher Anastasio. It is September 17th, 2024, although likely this video isn't airing until the 18th of September, so happy yesterday. I want to jump on here real quick, guys, and share something with you that I meant to read back in July, and I forgot to, and I just discovered it today, and I just noticed some things in it that I thought would be relevant for you to hear with regard to the distress that's brewing in the commercial real estate sector. I'm going to switch over. You're probably not going to be able to see my face anymore, which might be a good thing. But I'm going to switch over to a PDF document here that contains the article that I'm referring to that came out in the Wall Street Journal. Real estate meltdown strains even the safest office bonds. Defaults in a corner of the commercial real estate debt market are surging, triggering losses. So again, this was from mid-July, and just going to switch back over here and make sure we're still going. Yeah, okay, great. So this article by Matt Wurz in the Wall Street Journal zeroed in on this very specific type of commercial real estate debt product known as a single asset, single borrower bonds. Held by investors such as banks, insurers, pensions, and mutual funds. So if I understand this correctly, guys, and I am not an expert here, there's a good likelihood I'm getting this wrong, but reading this article and coming across this term for the first time, my understanding is single asset, so we're talking about a single building or property, and then single borrower. So there's one entity, person, individual, etc., who borrows the money to control this asset or this piece of property. Okay, so that's why it says here a corner of the commercial real estate debt market. Obviously, there's other types of CRE out there besides this. But anyway, so that's what the article focused on. And a couple things I just want to point out to you guys that I think are really relevant here. So let's see, right here, they talk about some of these types of debt defaulting even before the due dates because the interest expenses soared when the Federal Reserve raised rates. That's a crux issue that I think is important to note about CRE and everything that's going on in the sector, is that this was a situation that grew out of a variety of factors. I mean, for example, you have shopping malls declining due to online shopping. Then all of a sudden they get hit with the COVID pandemic. Then all of a sudden they get hit with higher interest rates from the Fed 2 years later in 2022. So that's a key point just in general. So you see here the SASB, single asset, single bond, single borrower bonds were meant to be ultra safe, but rate of the loans at or near default nearly tripled over 2 years, hitting 8.7% in 2024. So they're probably going from 22 to 24 there. So that's a troubling sign, certainly within that particular sector. And take a look at this chart, guys, just to kind of underscore it when we're talking about SASBs. We're right here in 2024. You see a little bit of a lag here in terms of the bonds coming due, and then an enormous spike here in 26. I mean, right now we're at the 35 level, 35 billion, but we go to nearly, more than twice that in 26. And again, we're in range of that in 2027 here. So this looks like, if you're talking about SASB bonds, which again are a subset of CRE, which is already in general amounts of trouble, you're looking at a 26-27 event here. Okay. Now here's one of the big ones I want to point out to you guys. And if you're a follower of Nassim Taleb, if you have read The Black Swan, we'll come to that in a moment. There's a point I want to make before that, but you'll see where the Taleb Black Swan connection comes in here in a second. But take a look at this, guys. The losses are particularly jarring for investors because credit rating firms initially gave many of the bonds AAA ratings, higher than even U.S. Treasury bonds. The financial models behind the ratings never forecast property prices falling below the value of the debt. When the pandemic gutted demand for offices, private equity firms abandoned near vacant buildings and their debts, leaving bondholders holding the bag. So a couple of things here, guys. Echoes of 2008, 2009, 2010, right? Bonds getting AAA ratings that don't deserve them, right? Financial, ratings agencies essentially bought and paid for, or just rubber stamping, depending on your cynicism, saying these are AAA rated products that then go on to fail. So they're much worse than AAA in that regard. So we're seeing echoes of that again. Again, it's a problem that, in my estimation, never went away. It just got stuffed under the surface with things like the Dodd-Frank Act and all that garbage that came out over a decade ago. So it never went away, guys. It never changed. It's still going on. Don't be fooled. Don't be lulled to sleep. Okay, these AAA rated products are, in many cases, I'm sure, not AAA. And you see an example of it right here. And then this whole thing right here, guys, let's come to the Taleb thing. The financial models, of course, being produced by experts behind the ratings, never forecast property prices falling below the value of the debt. So they just ignored, they were just blinded to the black swan possibility. Okay, the black swan, the improbable event. What if the property price falls below the value of the debt? They didn't even run this scenario, didn't even investigate the possibility there. Okay, so this should be a very chilling statement to anybody out there who's listening to the talking heads on television, listening to the CNBCs, listening to ratings agencies, listening to politicians who don't know what the fuck they're talking about. When you have this kind of thing going on, this is why I say, guys, when this lid blows off, it's going to be epic, because this kind of garbage, this kind of fraudulent fucking behavior is still happening, just like it was in 08, 09, and 10. It's just gone silent. It's running silent and running deep, okay, to cite a submarine phrase there, okay? It's just hidden from view for us right now. It's not in the headlines. There isn't a big fucking meltdown going on right now. There isn't a big, huge depression or recession going on. So we're not hearing anything about it. But that doesn't mean it's not happening, okay? Let's come down here. Okay, I think there was one or two other points I wanted to... Yeah, bonds are getting hit now because debt is coming due on properties that were able to limp along for years. Malls started losing tenants to online shopping. Pandemic drove the shift to working from home. Then the Fed raised interest rates. So this is what I was talking about earlier. And you see here, when you go back to that chart, about half of all SASB bonds will mature by the end of 2028. So this is really a 24 to 28 event, but 26 and 27 are those really sensitive years. Let's see. Steep price drop leaves highly regulated lenders such as banks and insurers with two unpalatable choices. Selling the bond forces them to take a loss immediately. Holding on to them requires banks and insurers to reserve more capital against the bonds because they're viewed as riskier. And that would then aggravate this vicious cycle that's gripped malls and office buildings. So this is significant here, guys. Let's see. It talks about like where did these types of bonds come from? It's kind of interesting financial history here. If you guys want to see like why did they do it this way in the wake of the 2008 financial crisis. There was a couple other things here. And then I think, okay, so it just talks about, it gives an example of a Blackstone property that was, I guess 605 million and then was sold for 200 million or something like that. Just a stunning, staggering loss. And they go on here to list all the SASB bonds, or a batch of them, I guess. They're backed by delinquent loans. You guys can see kind of the extent of that. And I believe that was the last thing I wanted to show you guys here. So anyway, guys, this whole video is to just kind of drive home for you guys the reality that CRE is distressed. There's this particular part of CRE that's under significant distress, and we are the foxes are guarding the hen house. Okay, just think about that when you think about where things stand from a financial regulation standpoint, from a financial soundness standpoint. It's really not good, and I think some of the things highlighted in this article point to those realities that are kind of passing the average Joe like you and me, just passing us by, because the lid hasn't blown off yet. When it gets blown off, all this junk is gonna come to the surface, and it's gonna be like, oh my God, this stuff is still going on. I thought we fixed this back in 2010, and it's bullshit. The system is rigged. to allow these things to happen so that a very small percentage of people profit off of it. When it blows up, you and I bail them out. And it will happen again. It will happen again here in the next year or 2 years, or whenever the fuck it happens. It's going to happen again, just like it did in 08, 9, 10. Okay? Hope you guys enjoyed the video. If you guys have any comments, questions, would definitely appreciate it. Love to see that. If you like, share, subscribe, any of those things for this channel. If you've watched a video on this channel and you didn't do any of those things, I still appreciate you very, very much for coming by and checking out the content in the channel. All right? Thanks, guys. Hope everybody has a great, well, Tuesday night, but even if you're watching this after Tuesday. All right. You guys have a great night. Bye-bye.